Something happened quietly on January 1st, 2026, that most Americans completely missed. While everyone was watching football and fireworks, China flipped a switch, and the global silver market will never be the same again. Here is what I know. The smartest money in the world, hedge funds, sovereign wealth funds, billionaire family offices, started aggressively accumulating silver months before most people even heard about it. And by the time this video is over, you will understand exactly why. You will understand the supply shock, the China strategy, the industrial demand bomb, and the one number, the gold to silver ratio, that tells sophisticated investors when silver is screaming to be bought. Stay with me, because the information in this video took me weeks to pull together, and it could be worth a lot to you. Welcome back. If you are new here, this channel exists for one reason: to give you the kind of financial analysis that used to be locked behind $10,000 a year institutional research subscriptions. Today we are going deep on silver. Not a surface level, silver is going up video. We are talking about geopolitics, supply chain warfare, the playbook China ran on rare earths and is now running on silver. We are talking about 5 consecutive years of global supply deficits, COMEX inventory levels that should terrify every industrial buyer in America, and a gold to silver ratio that, historically, has always corrected. By the end of this video, you will be able to have a more informed conversation about silver than 99% of investors in this country. Let's get into it. Part 1. The numbers that matter right now. Let me start with a number: 5. That is the number of consecutive years, 5 in a row, that global silver demand has exceeded global silver supply. 5 years of deficits. 5 years where the world consumed more silver than it produced. According to the Silver Institute's 2025 World Silver Survey, the global silver market ran a deficit of approximately 187 million ounces in 2025 alone. Now here is why that number is stunning. Mexico, the world's largest silver-producing nation, mines roughly 200 million ounces per year. That means in a single year, we burn through nearly 1 full year of Mexico's entire national output just to cover the gap between supply and demand. And this is not a new problem. The cumulative 5-year shortfall between 2021 and 2025 is estimated at 820 million ounces. That is roughly equivalent to an entire year of global mine production, just gone. Drawn down from above-ground stockpiles, from exchange warehouses, from private vaults. Meanwhile, what is silver doing in price? In 2025, silver surged approximately 100% year over year, outpacing gold, outpacing the S&P 500, outpacing nearly every major asset class. Silver reached a historic peak above $57 per troy ounce in late November 2025, breaking a nominal record that had stood for decades. And here is what separates amateur investors from professionals. They know that silver's best moves are usually ahead of public awareness, not after. So the question is not, why did silver already go up? The question is, what happens next, and is it too late? I'm going to answer both of those questions, but first, you need to understand why silver is structurally different from any other commodity on Earth. Part 2. Silver is not just a precious metal anymore. Here is the single most important thing most investors get wrong about silver. They think of it as a shiny rock, a safe haven asset, something you buy when the economy gets scary. That mental model is outdated. Modern silver is what I call a dual demand metal. It functions simultaneously as a monetary metal and as an essential industrial input. And that dual nature is what makes the current setup so powerful. Let me break down the industrial side, because this is where the story gets remarkable. Industrial demand now accounts for approximately 59% of all silver consumption worldwide. Think about that. More than half of every ounce of silver produced goes directly into manufactured goods. And not ordinary goods. We are talking about the technologies that are supposed to define the next 50 years of human civilization. Solar panels. Silver is used in the electrical contacts of virtually every photovoltaic solar cell on the planet, and solar is not a niche energy source anymore. The International Energy Agency projects massive global solar capacity expansions through 2030. Every panel needs silver. The World Bank has estimated that the development of renewable energy could result in a 4.5-fold increase in silver demand by 2050. Electric vehicles. A standard electric vehicle contains approximately 25 to 50 grams of silver, embedded in its electrical systems, battery management circuitry, and power electronics. As EV adoption scales globally, that represents hundreds of millions of new ounces of annual silver demand that simply did not exist a decade ago. Artificial intelligence. This one surprises people. AI infrastructure, data centers, high-performance computing chips, server interconnects, all require silver for their electrical conductivity. Silver is the most electrically conductive metal on Earth. There is no substitute that performs at the same level without massive engineering trade-offs. Defense applications. This is the category nobody talks about publicly because the data is classified. But defense analysts are consistent on this. Silver is embedded throughout modern weapon systems, radar, missile guidance, and communications technology. The US military is a significant, non-negotiable silver consumer. Now here is where demand meets a wall called supply inelasticity. Global silver mine production peaked in 2016 at roughly 900 million ounces per year. By 2025, that figure has declined by more than 7%, even as silver prices have roughly doubled over that same period. Why can't miners just produce more? 3 reasons. First, approximately 70% of silver is mined as a byproduct of base metal mining: copper, zinc, lead. Silver mines don't make production decisions based on silver prices. They respond to copper markets, zinc markets. Silver is a passenger, not the driver. Second, opening a new primary silver mine takes 8 to 12 years from discovery to first production. The supply cavalry is geologically stuck in traffic. Third, ore grades are declining globally. Miners are working harder to extract less silver per ton of rock. Reserve depletion is real and accelerating. The bottom line? You have rising demand colliding with structurally constrained supply. That is not a trade. That is a macro trend. Part 3. The China story. The deep secret most analysts won't touch. 11 to 1730. Now I want to talk about something that most financial commentators are dancing around, because it involves China, and it involves a level of strategic economic warfare that should make every American investor pay close attention. Let me take you back to 2010. In 2010, China began implementing licensing requirements on rare earth metal exports. Not a ban, just paperwork, just approvals, just quotas that somehow never quite met Western demand. The result? Rare earth prices spiked as much as 4,500%. Western manufacturers, companies building smartphones, missiles, medical equipment, discovered they could not operate without Chinese permission. A generation of supply chain executives learned that lesson the hard way. Now China is running that exact same playbook, on silver. Starting January 1st, 2026, China implemented new export restrictions on refined silver. Only large, state-approved companies can now export silver, and only after obtaining special government licenses. To qualify, a firm must have annual silver production capacity of at least 80 metric tons and maintain a credit line of at least $30 million. What does that mean in practice? It means hundreds of small and mid-sized Chinese silver exporters, companies that have long been key suppliers to Western industrial buyers and refineries, are locked out of the export market overnight. And here is why this matters at a scale most Americans do not appreciate. China controls between 60 and 70% of the world's refined silver supply. This is not mining production. This is refined, processed, ready-to-use silver. China's dominance in silver refining infrastructure is total. They built it deliberately over decades, and now they are closing the gate. This policy, according to analysts at FX Street, is turning a long-term shortage into an immediate global crisis. Here is the physical evidence. COMEX registered inventories, the silver available for delivery in U.S. commodity markets, are down nearly 70% since 2020. The London Bullion Market Association vaults have lost around 40% of their holdings. Shanghai inventories have fallen to their lowest level in a decade. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves. 30 to 45 days. That is not a warning light. That is a 5-alarm fire. But China's strategy goes deeper than export restrictions. Let me tell you what China has been doing quietly for years that the mainstream financial press barely covers. China has been a net importer of silver from the West while simultaneously restricting its own exports. In the first 11 months of 2025, China exported approximately 4,600 metric tons of silver, but imported only 220 tons. Here is the question that should be burning in your mind right now. Where is all that imported silver going? The theory held by a growing number of market analysts is that China has been building strategic silver stockpiles, undisclosed reserves, held for domestic manufacturing priorities and as a geopolitical leverage tool. These are not listed on any public exchange. They are not reported to international commodity bodies. China has, in effect, done with silver what it did with copper in 2005, quietly accumulated massive strategic positions before restricting outflows and letting prices rise. In 2005 and 2006, copper prices roughly tripled. The government publication Charlie Garcia, founder of R360 Financial Advisory, wrote in MarketWatch put it directly. China just weaponized silver, and they did it while Americans were busy arguing about whether Bitcoin is real money. His analysis is stark. China has figured out something Washington has not. The clean energy transition runs on metals. Whoever controls the metals controls the transition. If you want to build solar farms, electric vehicles, AI data centers, and next-generation weapons, you need to negotiate with Beijing. And the defense angle is perhaps the most alarming part of this story. Silver is embedded throughout modern weapons systems, radar arrays, missile guidance, electronic warfare equipment, and precision munitions. There are no hard public figures on defense silver consumption because the data is classified. But defense analysts consistently describe it as significant. At a time of rising geopolitical tension, when US-China competition for technological supremacy is intensifying, America's industrial dependency on Chinese refined silver is a strategic vulnerability that has received almost no public discussion. Think about what it means if, in a future moment of geopolitical crisis, China tightens the licensing regime further, or stops issuing approvals entirely. This is not a theoretical risk. China did exactly this to Japan with rare earths in 2010 during a maritime territorial dispute. Japan had to completely restructure its supply chains in response. Part 4. The gold-silver ratio. The signal smart money watches. Now I want to walk you through the single most important valuation metric for silver investors. The gold-to-silver ratio. Here is how it works. The ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When it is low, silver has caught up. Historically, going back millennia, the average ratio has ranged between 15 to 1 and 67 to 1. For most of modern financial history, the ratio has averaged approximately 67 to 1. As of mid-2025, the ratio stood at approximately 91 to 1, meaning you needed 91 ounces of silver to buy a single ounce of gold. Silver was extraordinarily cheap relative to gold by any historical standard. Here is what always happens in a precious metals bull market. Gold moves first. Gold is driven by central banks, sovereign funds, institutional players. Then silver catches up, and when it does, it moves faster and further than gold. This is historically consistent without exception across every major bull cycle. According to research from Bullion Vault Director of Research Adrian Ash, if a global recession does not materialize, silver could produce 3x the returns of gold in this cycle. And here is the macro backdrop that is fueling both metals simultaneously. The U.S. national debt is now above $36 trillion and growing at roughly $1 trillion every 100 days. The Federal Reserve has been cutting interest rates. A weaker dollar environment historically benefits hard assets, gold, silver, real estate, commodities, because it takes more paper dollars to buy the same amount of physical metal. Fidelity International recently doubled its gold holdings to 10% in select portfolios and publicly called silver the undervalued monetary metal with leverage to growth. Russia and India have reportedly added physical silver to their reserve holdings. Saudi Arabia made its first ever purchase of the SLV Silver ETF, a sovereign wealth fund entering the silver market for the first time. Central bank de-dollarization is real, and silver, cheaper per unit than gold, physically deliverable, with genuine industrial utility, is emerging as a de-dollarization vehicle that even developing nations can participate in. Part 5. How are investors actually buying silver? Let me walk you through the main entry points because not all of them are equal. Physical silver, bars and coins, gives you direct ownership with no counterparty risk. In times of financial stress, physical metal is the most defensible form. The downside is storage, insurance, and the bid-ask spread when you buy and sell. But for long-term wealth preservation, physical remains the foundation. Silver ETFs, primarily the iShares Silver Trust, ticker SLV, give you liquid, exchange-traded exposure without the storage burden. SLV has seen extraordinary inflows. Note that ETF shares represent a claim on silver held in trust, not direct physical ownership. For most retail investors, a combination of physical and ETF exposure makes sense. Silver mining stocks. Companies like Pan American Silver, First Majestic Silver, Wheaton Precious Metals offer leveraged exposure to the silver price. When silver moves up 10%, a well-run mining stock might move 20 to 30%. But the leverage works both directions. Miners carry operational, geological, and geopolitical risk. This is the highest risk, highest reward entry point. Sprott Physical Silver Trust. For investors who want the security of an allocated, audited physical trust. Sprott raised approximately $1 billion into their physical silver trust in 2025, the second largest physical silver fund in the world. For position sizing, most serious financial advisors suggest between 2% and 10% of a total investment portfolio allocated to precious metals. Conservative investors may target 2 to 5%. More aggressive investors seeking direct exposure to the monetary metals thesis might go higher, particularly through mining equities. And here is the critical insight from professional investors. Dollar cost averaging. Buying consistent amounts at regular intervals regardless of short-term price is the most time-tested way to build a silver position without trying to time an inherently volatile market. Silver earned the nickname the devil's metal for a reason. It moves fast in both directions. The discipline of consistent accumulation over time is what separates investors from speculators. Part 6. The risks. Because authority means telling you both sides. I would be doing you a disservice if I only told you the bull case. There are real risks to a silver position, and you need to understand them. Volatility. Silver is approximately 1/10 the size of the gold market. Smaller market means price moves can be violent and fast. In 2011, silver fell nearly 30% in a matter of weeks after the CME raised margin requirements. This can happen again. If you cannot stomach a 20 to 30% drawdown without panic selling, silver is not the right position for your psychology. Substitution risk. At very high silver prices, industrial users have incentive to engineer silver out of their products. Solar cell manufacturers are already working on lower silver and silver-free cell designs. At prices above $100 per ounce, some analysts believe substitution research will accelerate. These transitions take years. They do not happen overnight, but they represent a long-term ceiling pressure on demand. Regulatory risk. The CME has historically raised silver margin requirements during rapid price spikes, forcing leveraged players to sell. Futures market interventions are unpredictable and can cause sharp, rapid price reversals that have nothing to do with physical fundamentals. Paper market disconnect. There is a growing and legitimate debate about the relationship between paper silver, futures contracts, and physical silver. Some analysts argue that the paper market has historically suppressed silver's true price. As physical scarcity becomes more acute, this disconnect could resolve violently in either direction. These are not reasons to avoid silver. They are reasons to approach it with the right position size, the right time horizon, and the right psychological framework. Closing. The premium summary. Let me bring this together for you. Here is what we know with high confidence. Silver has been in a structural supply deficit for 5 consecutive years. The cumulative shortfall is approximately 820 million ounces, close to an entire year of global mine production. That deficit is not closing anytime soon because supply is inelastic, and mine development takes a decade. Industrial demand is accelerating, driven by solar energy, electric vehicles, artificial intelligence infrastructure, and defense applications. These are not speculative demands. They are contractual, engineering-driven, non-negotiable. China has weaponized silver. They are running the rare earth playbook, restricting exports, building strategic stockpiles, and positioning themselves as the gatekeeper of the world's most critical industrial metal. COMEX and LBMA inventories are at multi-decade lows as a direct result. The gold-to-silver ratio, a historically reliable valuation signal, spent most of 2025 at extreme levels, suggesting silver was deeply undervalued relative to gold. That ratio is beginning to compress, meaning silver is catching up. Macro conditions, rising debt, rate cuts, dollar weakness, de-dollarization, are providing a tailwind for both precious metals that shows no sign of reversing in the near term. Now, none of this is financial advice. I am not your financial advisor. Everything I have shared with you today is based on publicly available research, market data, and expert analysis. Before making any investment decision, consult with a qualified financial professional who understands your personal situation. But I will say this: the investors who are moving early on silver right now are not retail speculators chasing a Reddit thread. They are institutional fund managers, sovereign wealth entities, and family offices who have spent years watching the data. They are buying physical silver, silver ETFs, and silver mining stocks, because the fundamental case has become too compelling to ignore. Whether you act on this information or not is entirely your decision, but now you have the information. If you found this analysis valuable, and I genuinely hope you did, please consider subscribing to this channel. Hit the like button. It helps this content reach more people who need to see it. And drop a comment below. Are you already holding silver? Are you thinking about it? What questions do you have? I read every comment, and I will see you in the next one. Subscribe for weekly deep dives on the markets, macro trends, and the investments that institutional money is watching.